Hello and welcome to AI Market News by LM. This video's audio is automatically generated by NotebookLM, an AI-powered tool. The reference sources used in this summary are listed in the video description. As this content is AI-generated, there may be errors in proper names, pronunciation, or unnatural speech. This video does not provide investment or trading advice. Please make investment decisions at your own discretion. All right, let's dive in. When we look at the markets right now, on the surface, it looks like one big party, doesn't it? But just underneath all that celebration, a classic tug of war is raging, a real battle between pure greed and this deep nagging fear. Today, we're going to pull back that curtain and see who's actually winning. So let's start with the big picture, the story that's grabbing all the headlines. Right now, US equity markets are on an absolute tear, pushing into territory that we've just never seen before. I mean, just this past Friday, the S&P 500 closed at a fresh record 6,664.36. And it's not alone. The NASDAQ also soared to new peaks. Now, this isn't just some small jump. This is the result of a massive multi-trillion-dollar rally, with big tech really continuing to lead the charge. And you know, that really leads us to the multi-trillion-dollar question. Is this incredible run actually built on solid ground, or is there something else happening just beneath the surface? This is where our tug-of-war really begins. To figure that out, we have to look past those big headline numbers and try to decode what the market is really feeling. So let's pop the hood and check the engine, see what's going on in there. And you know, the first signal that things might not be as rosy as they seem comes from something called market breadth. Think of it like this. If an army is advancing, we want to know if all the soldiers are moving forward together or if it's just a few generals charging ahead while everyone else is actually falling back. Well, market breadth tells us exactly that. And here's what that looks like in reality. This data from FinViz shows that on the New York Stock Exchange, only about a third of stocks are actually advancing. Meanwhile, nearly 2/3 are declining. That is not a healthy broad-based rally. It tells us that this entire advance is being pulled forward by a very, very small group of companies. As CNN Business puts it, a few huge stocks can easily skew the returns for the whole market, masking a lot of weakness everywhere else. This kind of concentration is a classic sign of caution. It's the fear side of our tug-of-war winning some serious ground. In short, this rally is dangerously narrow. Okay, so if the internals are flashing some serious warning signs, let's look at the other side of the rope. What's fueling the greed? What on earth is giving investors the confidence to keep pushing prices higher? And the answer, really, in short, is the Federal Reserve. The single biggest driver of all this optimism right now is the widespread belief that the Fed is not done cutting interest rates. See, lower rates make borrowing cheaper, and they can make stocks look way more attractive than bonds, which is a really powerful incentive for investors. So how do we measure this expectation? Well, one of the key tools for this is the CME FedWatch tool. It analyzes the futures market to calculate the probability of a Fed rate move, and it gives us a real-time gauge of what the market is actually thinking. And right now, that gauge is crystal clear. The market is fully pricing in more rate cuts from the Fed this year. This belief, this great underpinning, is what's giving investors the confidence to just ignore that weak market breadth and keep on buying. Now, this tug-of-war isn't just a US story either. We can see the exact same dynamic playing out in global currency markets. And a perfect example of this is the Japanese yen. Just look at this deep division. On one side, we have hedge funds. They're typically the short-term traders, betting heavily that the yen will fall. And on the other side, we have asset managers, who usually take a longer view, betting it will rise. And this isn't just some small disagreement. The gap between these two positions is the widest it has been since 2007. We can even see exactly where the battle lines are drawn. This is a snapshot of the Owanda order book. Notice that huge cluster of sell orders just above the current price, and then that big cluster of buy orders just below it. These are like the defensive walls each side has built. It's a perfect, real-time picture of this massive conflict. So, with the market at this huge crossroads, what's going to tip the scales? Let's look at the week ahead and the key data points that will determine whether fear or greed gains the upper hand. Looking at the calendar, this week is packed with potential market movers. We're going to hear from key central bankers on Monday, but the main event, the big one, is on Friday, the U.S. core PCE inflation report. This is the Fed's absolute favorite inflation gauge, and it will be crucial in deciding their next move. So here we are, perfectly balanced on a knife's edge. We've got record highs built on the hope of rate cuts, while just underneath, the foundation is cracking. This week's inflation data could be the one single event that finally snaps the rope in this incredible tug of war. Thanks for watching. Don't forget to like and subscribe.